In New York, tropical storm Faye is near Cuba. That prompted evacuations from rigs and production platforms in the Gulf of Mexico. Still, gains were limited, and that's on speculation slowing U.S. economic growth will trim fuel demand. On Friday, oil fell to a 15-week low. Welcome to our twice-weekly commodities segment, and joined now by Purus Saxena, who's Chief Executive of Financial Advisor Purus Saxena Limited. Very good day. Thanks for joining us today.
My pleasure, Paul.
First of all, a quick look at price, both in the short term and then in the medium term. What do you think?
Well, I think the correction may run a bit longer. I think the price of oil may come down to perhaps $100, maybe even $95. But nobody's ever made a fortune betting on the short-term trends. It may be that prices stabilize here and then higher. Over the longer term, I think prices are going to go much, much higher.
You could have made a fortune shorting oil in the short term over the last month, I guess. But when you say much, much higher in the long term, how much higher?
Paul, I don't know, to be honest. I think the prices could go $200, $300, $400 a barrel. Who knows? The point is that the demand for oil is rising. The supplies for oil are extremely tight. Over the past 35 years, we have had one gigantic oil field discovery in the Caspian Sea in Kazakhstan. And Kashagan oil field has still not produced a single drop of oil in the market after 7 years. And this is despite the fact that some of the best oil companies in the world have been working day and night to get that oil to the market. And it hasn't happened. And on the supply side, I'm afraid we are past peak oil as far as the conventional crude oil is concerned, and we are now in the second half of the crude oil era. Peak oil doesn't mean the end of oil, it just means that we have gone from the first half where production was rising into the second half where production will decline. And this is not going to keep oil prices at $100 unless we see a massive depression all over the world. I suspect prices are going to go much higher.
Well, that's the issue, isn't it? It doesn't matter if supply is falling, if demand is as well. Now, demand is falling in the US. It's looking weak to a certain extent in Europe. It's clearly not looking weak at the moment in emerging Asia, notably China and India. But if the world does suffer, if the demand for exports from China dries up, if India suffers some kind of a financial crisis because of inflation, you may see demand drop, mightn't you?
Oh, we would. At some point, we would have to see demand destruction. Otherwise, we're not going to be able to keep this system afloat. We cannot consume more resources than we can produce. This is just a fact which some economists seem to forget. People talk about supply and demand, and people assume that prices go up high enough, we will get more supply. But when you're talking about crude oil, which is a finite resource, it is not as simple as that. Demand will have to destruct.
But you're saying it won't destruct at these kind of prices?
Absolutely not. Demand, even now at these prices, is rising by 1%. At today's prices all over the world. For sure, OECD demand has been in decline for some time now, but demand for oil from OPEC, from Russia, from India, from China, from the other developing countries is still rising very rapidly.
Okay, tell us how to make money out of this. For a start, would you buy physical oil or would you buy oil-related stocks?
A combination of both. My firm manages money for clients, Paul. We invest all over the world, and in the past few weeks we've been very, very active buying some top-quality upstream companies, some oil and gas exploration production companies. We're also buying oil and gas service stocks, the drilling companies which are making a fortune. Their basically equipment is booked out for 4 or 5 years in advance. They're getting record high day rates, so the drillers look very attractive. We're also waiting for some signs of a completion in this oil correction so we can buy some physical crude oil itself for our clients.
On the rig side, we spoke to the Singaporean rig builder KS Engineering only last week, who told us that for sure their profit was down, net income was down, operating profit was up, but there's definitely a cost squeeze going on there. It costs a lot of money to make these rigs and to staff these rigs nowadays. Does that not put you off the rig operators at all?
No, there's actually a reason to be bullish, because if you can't get drilling rigs quick enough on the market, then the drilling rigs which are existing and out there, they're going to collect even higher and higher rates, and that's exactly what we are seeing. We are seeing record high rates of $600,000–700,000 US a day for some of these deep water offshore drilling rigs, and Petrobras has been busy basically scooping up all the drilling rigs they can find for exploration work in offshore Brazil. And I think that this is a problem which is going to have a big impact on the price of oil, because not only do we have a shortage of drilling rigs, Paul, we have a shortage of petroleum geologists, we have a shortage of pipelines, we have a shortage on the entire infrastructure. So even if the 170 odd new rigs come online within the next 2 or 3 years, where are we going to find the 30,000 skilled people to operate those rigs? We've left it too late.
And what about the explorers? As you know, companies are out there looking for more oil, and many of them are producing oil, but a lot of them are producing what used to be considered marginal fields. These are small fields, or ones where the oil or even the natural gas is a byproduct of other operations in that area. Do you like these kind of companies? They are taking a risk.
Oh, there is risk in everything you do, Paul. Any business is risky. Anyone who says it isn't.
But do you think the risk is underpriced at the moment in the
we
market?
believe that the E&P companies, the small cap, the medium cap, exploration and production companies, which is what we've invested in, are extremely cheap. You look at the earnings, the price earnings ratio is 8 or 9. All the companies which we own for our clients have been increasing their production for the last 4 or 5 years. They have been increasing their reserves. So of course you have to do some homework and find the good companies, but we have a lot of shales now in the United States, Marcellus shales, Haynesville shale, and a lot of these companies are now making an absolute fortune because the reserves are increasing. I would not invest money in the large cap integrated oil and gas companies because their production as well as reserves are in decline. But if you pick up the smaller companies who have the ability to increase production and reserves in this environment, they are going to make an absolute fortune in the next 5 to 10 years.
Okay, so go upstream on the stocks and look for physical oil once it's fallen down below $100 a barrel. Puru, thank you very much for that.
My pleasure.
Puru Saxena of Puru Saxena Limited.